Tech volatility is spiking again, just as Europe faces a heat-driven energy squeeze and central banks step back from being the market safety net. Together, those forces are reshaping the risk and reward mix across equities, bonds, credit, currencies, and commodities. You are watching vTalkInsight, Allocator's Lens Daily for June 25, 2026. Let's start with the equity picture, where artificial intelligence, earnings momentum, and concentration risk are all colliding. In equities, the central tension is between intense short-term tech volatility and a still powerful artificial intelligence earnings story. The semiconductor complex has just endured an almost 8% one-day drop in the Philadelphia Semiconductor Index, mirrored by sharp swings in Asian chip names in Korea and Taiwan. Leveraged exchange-traded products and tighter margin policies at local banks have amplified those moves, driving record intraday volatility even where company fundamentals have not shifted dramatically. Despite that, global benchmarks are only modestly below recent highs, and volatility gauges have moved from the mid-teens to the high teens rather than exploding. That pattern suggests stress is concentrated in specific themes rather than signaling a systemic break. At the heart of it sits the artificial intelligence complex, with Micron's upcoming earnings treated as a bellwether for the whole memory and high-bandwidth demand story. The setup around Micron is finely balanced. Expectations lean toward a beat and raise, and industry commentary still points to memory supply remaining tight well into January 1st, 2027, while hyperscaler capital expenditure plans are being revised higher. Yet the stock has already re-rated aggressively, and recent experience shows that even companies beating forecasts can see share price punishment when valuations are stretched or when management language hints at a cyclical peak. Beyond Micron, leadership is narrowing. Recent global equity gains have been concentrated in technology and energy, and within tech the artificial intelligence trade is fragmenting. Capital is rotating from semiconductors into the largest cloud and platform names and a handful of software beneficiaries, while several dedicated AI hardware and chip makers are under pressure as they fail to clear very elevated expectations. That combination raises classic concentration and crowded trade risks, especially as central banks signal less willingness to backstop equity drawdowns than in previous cycles. Regional divergence adds another layer. U.S. equities are rebounding from the latest tech-led sell-off, supported by stronger manufacturing, new orders, and exceptionally easy domestic financial conditions. In Europe and parts of Asia, by contrast, flows have faded, exchange-traded fund inflows have reversed since the onset of war, and sectors such as German autos and some traditional investment structures remain under pressure, contributing to underperformance versus the United States. Even so, there are pockets of renewed interest, including European banks benefiting from a steeper bond curve and improving earnings revisions, and pharmaceuticals where valuations look less stretched and positioning is lighter than in crowded growth segments. Putting it together, the equity backdrop still leans on artificial intelligence and U.S. cyclicals for upside, but earnings momentum and stock-level selection matter more than index beta. Key watch points are Micron's message on AI memory demand, how other beneficiaries talk about power, capital expenditure, and margins, and whether the expected summer range trading holds if chip volatility persists. Turning to rates, the message is that policy remains restrictive and the traditional bond hedge is less automatic, even as many see value in parts of the curve. In the United States, a structural rise in term premium is expected on treasuries, driven by large and persistent fiscal deficits and higher debt to GDP ratios, with some estimates pointing to room for yields to rise another 20 basis points from here. That backdrop is reinforced by the upcoming personal consumption expenditures inflation data, where risks are judged skewed toward a hotter reading that could push yields higher and challenge equity valuations. In the euro area, the outlook is more nuanced. The next European Central Bank decision is seen as finely balanced, with any possible September hike framed as an insurance move rather than the start of a fresh tightening cycle, while ongoing fiscal and defense spending still offer a modest growth tailwind. The United Kingdom stands out as a market where gilts carry an additional political risk premium tied to persistent uncertainty, even though some investors judge current yields attractive if policy credibility holds and inflation continues to grind lower. Across major markets, a common theme is that sovereign bonds are no longer viewed as a one-way safety net. That is pushing allocators towards selective maturities, often around the 3 to 5 year area, and greater reliance on active management. The crucial signals from here will be the PCE print and how central banks frame any upside surprise in their communication. In credit, public markets still broadcast confidence, while private channels and select sovereigns flag areas of stress. In U.S. investment-grade debt, inflows into high-quality corporate bonds are running at several times last year's pace, and spreads remain tight. Combined with very easy overall financial conditions, that points to strong appetite for yield and a belief that the cycle can extend without an imminent recession. European corporate bond spreads tell a similar story. They remain compressed on the expectation that resilient consumers and continued fiscal support will help the region skirt a formal downturn, even against a challenging energy and industrial backdrop. This picture of tight spreads and robust demand contrasts with what is emerging in parts of private credit and in distressed sovereigns. Morgan Stanley's large private credit fund has begun capping investor withdrawals at around 5% amid elevated redemption requests, highlighting liquidity mismatch risk in a sector that has grown rapidly to roughly the low trillions of dollars. At the same time, Venezuela is preparing to disclose a debt burden far above market expectations, pointing toward an unusually complex sovereign restructuring and reminding investors that tail risk remains very real in high yield and emerging market debt. Together, these developments suggest that while carry remains appealing in mainstream credit, the quality of cash flows and robustness of liquidity are becoming critical differentiators. In foreign exchange, the dominant story is how politics and growth trajectories embed in a currency and rate risk premia rather than any single daily move. The United Kingdom offers a clear case study. The Brexit shock delivered a sterling move larger than that seen during the early 1990s exchange rate mechanism crisis and has left the economy several percent smaller than it otherwise would have been. That legacy, combined with ongoing political uncertainty and debate over the next chancellor, is contributing to a persistent risk premium on gilts and constraining fiscal space. Against this backdrop, the Bank of England is signaling that its reaction function is guided primarily by inflation data rather than politics, and gilts are described as offering appealing yields once policy clarity improves. From a cross-asset perspective, this underlines how shifts in perceived policy credibility and growth potential can quickly feed through both to currency valuations and to local funding costs. In commodities, energy remains the key swing factor, but the direction now diverges between oil and power. On the oil side, supply is healing faster than demand. Crude flows through the Strait of Hormuz have recovered to around 60% of pre-war levels, with roughly 68 million barrels in transit, and Gulf exports are rising as security premiums fade. Global oil supply has increased by about 3 million barrels per day over the past year, helped by strong output from Brazil and the United States, while China's crude imports have dropped sharply. Surging electric vehicle adoption, especially in China, is raising doubts about whether oil demand will fully recover after the recent shock. These forces have pushed prices down toward the mid-70s and into a $70 to $85 trading range, even though gasoline inventories remain tight and diesel prices are only gradually easing for end users. In Europe, the immediate issue is electricity rather than crude. Extreme heat, low wind output, and nuclear curtailments have driven day-ahead power prices back to levels last seen during the energy crisis, while grids in France and the United Kingdom are facing transformer failures, operator alerts, and rolling outages. That combination threatens margins for energy-intensive industry and could reheat inflation pressures, but it is also accelerating interest in low-carbon, homegrown generation, refurbishment of inefficient buildings, and sustainable construction materials. For multi-asset allocators, the key question is whether the relief from lower oil offsets the renewed shock from European power, or whether these trends signal a shift toward a more persistent, climate-driven volatility regime in energy-linked assets. Stepping back, the cross-asset picture today is one of contained but elevated volatility. Equities still lean on artificial intelligence and U.S. cyclicals, but the semiconductor sell-off and narrow leadership make earnings and positioning more critical than index direction. In rates, higher-term premium and inflation risk argue against assuming sovereign bonds will always cushion equity drawdowns, while public credit remains firm even as private markets expose pockets of liquidity stress. Foreign exchange channels political and growth stories into local funding costs. And in commodities, easing oil contrasts with a renewed European power shock linked to climate extremes. Over the coming weeks, important signals will come from Micron and other AI bellwethers on demand, power and capital expenditure, from the personal consumption expenditures data and central bank messaging on yields, and from how energy market volatility evolves beyond Europe. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.